Hello, students. We are going to start in this lecture the meaning of money market, the importance of money market, what does money market mean, characteristics of money market, and we'll talk about the different instruments of the money market as well. What are the different characteristics of the different instruments? Now, what is money market? In our previous lectures, we have seen that whenever we have covered and talked about organization of the financial system, we have seen that market basically can be categorized into two types depending on whether it is short term or it is long term. Now, for the short term, we have seen that it can be categorized into money market, whereas in the long term, it is categorized into capital market. But one important thing is that this money market, it is basically short term debt market, whereas capital market is a long term market where both debt and equities instruments are available. But in money market, there is only debt instruments are available, no equity instruments are not there, equities are not available. Now, in this market, financial instruments with high liquidity and very short maturities are traded. Why we are talking about high liquidity? Because all the financial instruments, they are having very shorter maturities, and that's why what is happening is their maturity period is very short. Therefore, highly liquid instruments are there. Suppose for 1 week, the maturity is 1 week, you can buy that instrument. Even 1 week to few months, they are available. Usually, these instruments are the maturity period is less than 1 year. They are traded. All those debt instruments which are having maturity period which is less than 1 year, they are traded in the money market. So it acts as a means of borrowing and lending in the short term, with maturities usually ranging from overnight, it can be overnight also, to just under a year. Now, the money market, it is basically for funding over short time periods of 1 year or less. So instead of obtaining funding for operating expenses or capital investment, as they would with the capital market, the money markets, they are often used to fund immediate operating expenses, you can say, or to provide the capital, working capital also to corporates, to businesses. So this is basically very well known for obtaining the working capital finance. Money market transactions, they are usually wholesale, meaning that they are for large denominations and they take place between financial institutions and companies rather than individuals. Money market funds, they offer individuals also the opportunity to invest smaller amounts in these assets. In the financial marketplace, a distinction is made between the capital market and the money markets. The capital market we have already talked about, like it is a source of intermediate term to long term financing in the form of equity or debt securities with maturities of more than 1 year. The money market, it provides very short term funds to corporations, municipalities, and the government also. So money market securities, they are debt issues with maturities of 1 year or less. Now let us have a look about the different characteristics that are very important. From an investor's point of view, you can say the money market provides a safe place to invest without losing ready access to one's money. For example, an investor who needs liquidity and has little risk tolerance, they may put some of their money into treasury bills. Money market instruments give businesses, financial institutions, and governments a means to finance their short term cash requirements. So, usually, three important characteristics are associated with these instruments. What are those? First is liquidity. Since they are fixed income securities with short term maturities of a year or less, these money market instruments are highly liquid. Second characteristics which is associated is safety. Safety is, we can say that they also provide a relatively high degree of safety because they are issuers, they have the highest credit ratings. This is one of the important reasons that they are very safe and secure. They are usually issued, like treasury bills are issued by government. So they are the most safest one. Even you can say the minimum amount of risk is associated with the treasury bill. Now discount pricing. This is the third important characteristics which is common with all the money market instruments. That is, these are issued as at a discount to their face value and hence they are issued as a relatively cheaper rate. So they are issued at a relatively cheaper rate. You are getting it at a discount, and whenever you are trying to trade it or trying to sell it, the price is more. So that differences between a discounted price and a higher selling price, that amount actually acts as an interest rate to the investors. Now, before moving on to the different types of money market instruments, let me give a summary of whatever we have covered up. That is, three important characteristics: liquidity, safety, and discount pricing. Their money market instruments are used by corporations, governments, and individual investors seeking short term funding or short term places to invest money. There are several different varieties of money market instruments, but all have a few things in common. What are those? The three important characteristics. Now, let us move to the different types of money market instruments. There are several different varieties of money market instruments issued by both companies and governments. Some of the common types of money market instruments they include short-term CDs, like CDs for certificate of deposits, bankers acceptance, treasury bills, commercial paper, municipal notes, repurchase agreements or repos as well. So here this we are getting a pictorial view about the different types of money market instruments that are usually available, and we talked about them also. Now we will be discussing the different important characteristics about the different money market instruments. The first one and the safest one that comes into the mind is the treasury bill. Treasury bill, what are they? These are government debt securities with maturity of less than a year. T bills are issued to meet short term mismatches in receipts and expenditures. So it's a very having a very short term maturity is there. Most safe, we can say. Risk is very less because they are issued by the government. The longer the maturity date, the obviously the higher will be the interest rate that the T bills will pay to the interest. So depending on the maturity date, those T bills which are having a lesser maturity date, their interest rate are usually lower, and those with the longer, they are having an interest rate more than that. Now, these securities are widely regarded as low risk and they are highly secure investments. The second category that we are going to talk about is certificate of deposits. Now, what are certificates of deposits? Certificate of deposits, basically they are also written in short term as CD. It is a fixed income financial instrument governed under the Reserve Bank of India (RBI), issued in a dematerialized form. The amount at payout they are assured from the beginning. A CD can be issued by any all India financial institution or scheduled commercial bank. They are issued at a discount provided on face value. Like a fixed deposit, the CD's purpose is to denote in writing that you have deposited money in the bank for a fixed period and that bank will pay you interest on it based on the amount and duration of your deposit. So usually this certificate of deposits they are issued by banks and they are much similar to the fixed deposits also, but one major difference between fixed deposit and CDs, FDs and CDs is that these CDs are securities. They can be traded in the money market. Whereas FDs, they are non-securities form of investment. The ownership cannot be transferred. Whereas the CDs are securities and their ownerships can be transferred. And it is traded in the money market as well. Now, in simple words, a certificate of deposit, we can say it is a product which is offered by banks and credit unions that provides an interest rate premium. In exchange for the customer, they are agreeing to leave a lump sum deposit untouched for a predetermined period of time. So that's it. The promise is provided by the investor that this is the amount that I am depositing with the bank and I will not withdraw this, and for that, what is the rate of interest that you are going to give? Now, almost all consumer financial institutions they offer them, you can say. Although it's up to each bank which CD terms it wants to offer, there are different terms and conditions that are associated with the certificate of deposits. How much higher the rate will be compared to the bank savings and money market products, and what penalties it applies for early withdrawals. So, all these things may vary from one bank to another. Now, we move on to another important money market instrument, that is the commercial paper. Commercial paper, if you're talking about commercial paper, it is commonly a type of unsecured short term debt instrument which is usually issued by corporations. They are typically used for the financing of payroll, you can say accounts payable, inventories, and meeting other short term liabilities. It is issued in the form of promissory notes and it was introduced in India first time in 1990. So maturities on commercial paper they typically last several days and rarely range longer than 270 days. Commercial paper is usually issued at a discount from the face value and reflects the prevailing market interest rates. So these are also discount issued at discount. So all the money market instruments they have those three important characteristics in common. Whether they are certificate of deposits, whether we are talking about commercial paper, whether we are talking about treasury bill or any other money market instruments that will be studying later on. So whatever are they, these three important characteristics are always there. First one, what was it? High liquidity, safety, and discount pricing. So these are always there. Now, commercial paper and the certificate of deposit or the treasury bill, whatever we're talking about, commercial paper is the uh, most risky money market instrument, you can say, because it is unsecured and these are usually issued by the corporates. The fourth category is very important, that is the repurchase agreements. So, in our previous lecture, we have seen about repo rates, repurchase agreement that was made by the commercial banks with the RBI. That was the repo rate. It was deciding about what should be the rate. Another is repurchase agreement. It can also be made by others, like agreement. You can say it's like short-term borrowing agreements for dealers in government securities. So in case of a poor dealer, they sell the government securities to investors, usually on an overnight basis, right? And they government securities they sell and they borrow the money from the investors. It may be on an overnight basis or for you can say for longer period of time, and then they say that yes, we will buy back this security, government securities from you at this rate. So that is a repurchase agreement. So they buys them back the following day at a slightly higher price. So this slightly higher price that they are paying them or the investors are getting, this acts as the interest rate for investing their money or borrowing their money to this dealers. So that small difference in price is the implicit overnight interest rate. Repos are typically used to raise short-term capitals. So these are the important characteristics we have seen. The another category which is very important when we talk about the different money market instruments, they are municipal notes. Now let us have a look at what are municipal notes. Now a municipal note, it is a debt instrument by state and local governments to finance capital expenditures such as construction projects, etc. So usually whenever the municipal they decide to do some infrastructure development projects or construction projects in their area, they may issue this municipal notes to the general public and they can raise the required amount of fund from them. These municipal notes are appealing to investors because they mature in 1 year or less. Within 1 year, it should always be within maturity period of money market instruments cannot extend more than 1 year. So within this 1 year, and they also offer fixed income and are often exempt from income tax as well at the central or state level. So that's why they are very much appealing to the investors because they are getting an exemption from the income tax. So usually local and state governments they issue the municipal notes when they are trying to fund a project that benefits the region. So this is another important we can say money market instrument, that is the municipal notes, since they are tax exempted as well and they are less than 1 year, usually extend up to 1 year, and there are also very lucrative interest rates are paid to the investors. Municipal notes they make one payment upon maturity that includes both interest and principal payment, and then exempt from income tax as well. Another important instrument, if we are talking about, is the banker's acceptance. Now, what is this banker's acceptance? A banker's acceptance, we can say it is a short term issuance by a bank that guarantees payment at a later time. A banker's acceptance is often used in importing and exporting, with the importer's bank guaranteeing payment to the exporter. It is more or less like a letter of credit, same kind of thing. So when an importer they are importing, their payment is basically guaranteed by a bank from the importer side through an acceptance or written note that is passed on to the exporter, and it is termed as banker's acceptance. So in case the importer fails to pay the money, the bank will pay the money. A banker's acceptance differs from a post-dated check in that it is seen as an investment and can be traded on a secondary market. So it is like a post-dated check, like that only. The check is given and the letter and date is also put. But one thing is important: is bankers' acceptance can be traded in the money market, whereas the post-dated check it cannot be traded in any way. Applying for a banker's acceptance is similar to applying for a short-term fixed rate loan. It is like a similar kind of thing that we are applying for this and the bank is paying for this on behalf of the importer, and later on what the importer will do, they will pay back that money along with the interest. The borrower goes through a credit check and sometimes extra underwriting processes. So that extra underwriting processes basically acts as the extra amount of interest that is paid to the banks for issuing the banker's acceptance. Similar to buying a treasury bill, an investor on the secondary market might buy the acceptance at a discounted price but still get the full value at the time of maturity. So this is also associated with the three important characteristics of any money market instruments. A banker's acceptance is a legally binding obligation by the accepting bank to pay the stated amount at the maturity date of the time draft. So whatever is the time that is drafted in the check, like we talked about, it is like a post dated check kind of thing. So it is mandatory, it is legally binding obligation for the bank to pay that. So it can have maturity dates ranging from 30 to 180 days. 180 days means 1 month to 6 months usually. A banker's acceptance, it is a short-term debt instrument that helps to facilitate trade transaction between two parties when they do not have an established credit relationship. So they don't have an established credit relationship. So one party and another, or the exporter or the importer, they cannot trust each other. So in that case, a third party, that is the bank, comes into to deal with this, and they make the payment, or they give a banker's acceptance or a post-dated check to settle this transactions. An importer can use a banker's acceptance to finance his purchase of goods from foreign suppliers also. So after negotiating prices with the foreign exporter, the US importer creates a time draft and they present it to his bank. So the bank accepts the draft, discounts it, and gives the importer cash, which he uses to pay his foreign supplier. So this is the process we can say that is usually followed in the banker's acceptance. Now, in my next lecture, I'm going to cover DFID. What is DFID? Its meaning, its role. By that, thank you. Thanks everyone for watching.